I have around 50 slides, so it's going to go fast, but do please interrupt and ask questions anytime you like. Just a few words on myself. As of today, I am the CFO of Templafy. And it's actually funny, the reason before that I was working in TDC, which is the biggest telco in Denmark. And then I worked a few years in PreSeed Ventures, investing into all kinds of businesses. But actually the way that I got into Templafy was because I was really not just on Nicolaj, but I was the pain in the ass of everybody. And I was asking numbers and metrics all the time, and nobody could produce them. And this company, Templafy, they got so annoyed of having me asking the questions all the time, so they invited me in to do the work for them. So that's how I ended up there. So what I'm going to run through today is just to give you an idea on what Templafy is. I saw that unfortunately not everyone here knows what Templafy is, but I hope you get a grasp of what it is in a few minutes. And then I will jump into what is the actual fundamentals for creating a successful business, especially a SaaS business. Then I would like to dig into what the metrics you should care about. There's a lot of metrics out there, and there's a few of them that everybody asks all the time, and you should really get the understanding of those. And as Nicolaj was saying, you don't have to be really, really good at everything all at once. So I was just trying to give you an idea on when you have to be good at what, and to what extent do you have to know your metrics. And it becomes pretty crazy at a point. But I'll get back to that. I'll show you some examples from Templafy, how extensive our metric decks are these days. Okay, Templafy. The problem with huge organizations is that in huge organizations, they usually, it says business communication. They are really aware of how they communicate and what's the value proposition is, how their logo is positioned, what colors and everything, as long as it's regarding their website, advertising, and everything else. But when it comes to creating documents, the control is all in the hands of the end user. Meaning that a lot of people use the old templates that they were given 10 years ago. They use disclaimers that is no longer valid. They use wrong addresses, wrong everything. So there's being produced a heck of a lot of documents, and they're just not compliant. And for the employee part of the side, if you are trying to be compliant and you go to your brand space, download the latest template, it's just time consuming. It's annoying. So what Templafy is doing as one of the only one in the world actually is making sure that all the template and the documents that you need is right inside of your Microsoft Office suite. So whenever you need on-brand and compliant logos or templates or content pictures that is selected by a marketing department, it's right where you need it. And it helps you become really productive. So it's a big win for the ones who try to take care of the brand, and it's also a big win for the end users who are much more productive by using Templafy. So that is what we do. And what we're trying to do is actually become the center of the universe, sort of. We're trying to become the one, we are distributed wide on everybody's PCs inside of a huge organization. And so it allows us to be the one and only distribution platform that actually can allow other players to tap into it. So we could have the Dropbox coming to us and say, hey, we actually have 500 users within that company that you already have distributed your platform on. Can we please come in through your... So it's on top of being productive and a template management system, it's also a distribution platform, allowing us to be a very sticky product. So that's the company vision. And of course, this is the vanity metrics. Everything is daily do. I squeezed the graphs in so it leaks even steeper. And this is our MRR since the company started in October 14. It has gotten fast, and it still is going really fast. So MRR, committed revenue, and this is selected deals that we have done, Pricewaterhouse, Deloitte, IKEA, Ernst & Young, which is amazing for a company that's just 4 years old. And this is definitely by far my most vanity slide that I can produce. Squeezed in graphs and a lot of nice logos. Yeah. So that's a few words on Templafy, but to get back to the fundamentals for creating a good business, of course, what we have always been told, if talking to a bank and I want to create this business, they would try to make sure that, of course, you have less cost than what you are getting in as revenue, which is obviously a very good idea. And so you're being profitable all the time. And if you continue to do that and you make more revenue than you have cost, at one point in time you will just bundle up a lot of cash and what not to like. The thing is, if you're creating a SaaS business, that's usually not your business model, that you are creating much more revenue than your cost is initially. So you will run into cash issues. This is, of course, a very nice cash position to be in, but it's just not very realistic unless you are selling hot dogs or something like that. If you're selling software, you're usually standing in a situation in which you can recognize some revenue month by month by month, but you really don't know how long the customer will stay on. Will it be 3 months? Will it be 10 years? You really don't know. But what you do know is you have some pool of cost for generating that customer. So how many multiplies of the revenue do you need to have in order to get your money back? That's an imperative to understand. But given that most SaaS businesses have this thing where customers pay a bit upfront and you have very often a much more cost, you'll run into this scenario. And that's why it makes a lot of sense that venture capital exists, because banks don't like this, they don't understand this. So if you only get it, so I was just taking the other kind of customers and just trying to apply the same logic that I did on the previous slide, but instead of they paying it upfront for everything, they just pay a single amount. This is a projection on just getting a new customer in every month, but they stay on. So what this shows is you'll be needing some money at one point in time. And that goes for all SaaS businesses, unless you go really, really slow. And you can, of course, try to do that, but I wouldn't pursue that if you want to grow big. So when having a business model, you need to answer a few questions, of course. Do you actually know how your business model works? And is it good enough for you to attract investors? And I'll get back to what is the good enough levels for attracting investors. The consequences of not knowing is, in my point of view, is that you are walking in darkness. You really don't know what you're doing. And if you are going too fast, you might just run off the cliff, run out of money, and you'll crash, just like a lot of other businesses have done before you. And on the other hand, you don't want to go like this guy and going really, I don't know if he's driving massively fast, but it looks like he's driving slow. You don't want to go really slow, and because then it's going to take forever to build a company. Yeah, so it's a matter of finding the right balance. If you look at some statistics on how many companies succeed, there was somebody created this massive report a few years back, looking at how many startups actually live X amount of years. I think it was 10 years after they started, and so actually only 1 out of 12 succeeding. And the main reasons for not becoming good is a lot of companies, they were spending too much on getting customers, and they were hiring too many people before they were actually knowing what they were doing. So they run out of cash. And the main objective, of course, for looking into metrics is you need to know what is working well and figuring out what you need to improve. And it's also imperative that you really understand, so you know whether or not you should hit the accelerator or you should hit the brakes. When I was on the board of a company like Pento, I always keep asking questions into the metrics because I really didn't know whether or not it was good enough for us to accelerate and just throw more money into sales and marketing, or if it was actually not good enough and we should decelerate. So it's a matter of finding the right levels, and there's some certain metrics to give you an indication on that. And of course, it's imperative that you always have this forecast model in which you can look at your cash position and you have an idea when will you run out of cash. I have seen a lot of startups running out of cash because they are really lousy at projecting their cash, and for some odd reason they think tomorrow is going to be 10 times better than today without having any idea on whether that's actually the case. So metrics is just made for you to help you looking into the crystal ball much better. So what metrics should you really care about when creating a startup? The thing is, if you want to create a business case that is so interesting that investors would love to throw money in, you have to portray it like a money-making machine. That is what investors, they understand. If you can really make it clear for an investor that you have a machine in which you can throw in money and the minute after it comes out tenfold, they would love you. So you just need to get closer of portraying that, exactly that. And to break it down into simple buckets, what investors are looking into is, of course, profitability. And the way they look into your profitability is your expected customer lifetime value versus your acquisition cost. You really need to know what's the ratio between your lifetime value and your acquisition cost. And another thing you also need to be really good at is having an idea on the cash situation, because you can have companies that have a great expected lifetime value and the acquisition cost may be few, but if the cash that it generates takes forever to get to you, that is not really optimal. And besides those two things, you also need to have a growth engine. So it's not enough that you can sell to your grandpa and your mom, but there's need to be other in the market. It needs to be a huge market so people are really interested. So if you can convince somebody, investor, that you have a profitable business, you get your money back really fast, so you can throw it in again, and there's massive opportunity for growth. That's basically what you need to convince an investor. So in terms of lifetime value versus acquisition cost, there's a golden rule on the ratio. And the golden rule is you need to try to have your money back 3 times of what you have paid to get a customer. And the reason for that is, of course, you have other costs than your acquisition cost. Acquisition cost, marketing cost, sales cost, whatever cost related to generating that specific customer. And you have cost for overhead and management and delivery and whatnot. And so the golden rule is try to get your money back 3 times. And you shouldn't try to go for tenfold, because if you're doing tenfold, then you can say you're not utilizing. If I have a machine that is so efficient, maybe I would just throw that money into less efficient channels, because a level of 3 is still really good. So you shouldn't pursue any crazy number here, because you can, if you have a really good number, throw that money into new acquisitions. That would be my bet. At least if you want to make a big startup. So how can you create a very great lifetime value? One thing, and over acquisition cost. One thing is, of course, your acquisition cost needs to be low, but in order for you to keep a great lifetime value, it's imperative that your customers stay on for a long time. Because if a customer stay on for a long time, they're paying for many more months. Obviously, that makes a lot of sense. So this is a case from a company called HubSpot. They do marketing automation. And what's interesting, they shared some of their metrics. What's interesting here is that if you look at their lifetime, their acquisition cost in Q1 11, they had an acquisition cost of $6,000 for generating a customer. And in just a bit more than a year later, they started spending a bit more getting customers on, $6,700. But if looking at the lifetime value, it actually increased massively from $10,000 and to $31,000. And the reason for that is mainly due to the fact that they managed to reduce churn. They managed, instead of having a churn that is 3.5% per month, which is a really high number, they managed to put it down to 1.5, which is much more acceptable, meaning that the expected customer lifetime is increasing, and for that reason, your ratio between lifetime value and your acquisition cost rose from 1.7 to 4.7. So retention and the ability to create the customers is just, or have the customer stick is imperative. The way they did it, by the way, is they forced the customers to take a 4-hour class on their product. So before they are allowing the customers to use the product, they said, we insist that you spend 4 hours watching these videos and going through webinars. And that made it actually harder for some of the customers to stay on, but the ones that invested those 4 hours actually got to use the product instead of just having good intentions about it and then throwing away. So it's kind of crazy. You ask the customers to do something for you, and they stay on for a longer time. Yeah.
What does Mmr and churn mean?
MMR is monthly recurring revenue, and sorry for all my abbreviations. That is the amount of money that you get into revenue every month. And the MMR churn means how much of that are you losing month by month. So if you were getting $100,000 or just $100 in 1 month, the month later you would have 96.5, the month later you would have 93, and so on, right? So that's the churn, the loss of MMR per month. So, but as I said before, getting your money back several times is nice, but it's not sufficient. Because you really want to have your money back fast. If you are to get your money back these are 3 different scenarios on your cash position, depending on if you get your money back within 18 months or 6 months. The thing is, if I throw money into marketing and sales and that money comes back to me in 6 months later, I can throw it in again, and the ball keeps rolling. And that leaves a nice trajectory. If it takes 18 months for me to get my money back, I have to wait 18 months to get it before I can deploy it again, and that's a long time. So you really want to get your money back as soon as you can. So in Templafy, what we try to do in order for that to happen is, of course, we try to make the customers pay up front for as long as possible. Sometimes we ask them to pay up front for 3 years, and at least we ask them to pay for 12 months up front. And that's really no problem in the enterprise, especially when you cater for big enterprises. It's a completely different thing if you're a B2C company. If you're a Netflix or Dropbox, it's sometimes hard to ask for customers to pay up front for a year in advance. But it's nice to get your cash back really fast so you can deploy it again. So I try to portray my message regarding getting a good lifetime value over your acquisition cost, and the point about getting your money back fast in 4 different kind of businesses. The thing is, if you get your lifetime value over your acquisition cost, and that's low, and it takes a long time to get your money back, that's really not a great scenario. On the other hand, you can invest into a olive tree plantation. You can get your money back several times, but it's given that it takes an olive tree 80 years to grow up, it's gonna take you a lot of years to get your money back. So on that metric, it looks nice, but on the cash flow perspective, it's not really nice. So if you're really interested in making a fast buck, you can try to do these Christmas CDs. There's always out for Christmas. You can book your commercials 2 weeks in ahead, but you will only sell that CD once, and the customers will not remember you 2 weeks later. So you might get your money back really fast, but you won't get them back several times because it's not a recurring business. So what you're trying to look for is getting your money back really fast and get as good a ratio on LTV over acquisition cost. That's the only way that you can try to achieve becoming a unicorn. And a unicorn is expression for $1 billion company in the startup world. So if you want to achieve that, you definitely need to have fast cash payback and a high ratio on lifetime value. So getting to the third part of the equation, you have to watch out for the fake unicorns, because there's cases in which you can seemingly have a high ratio between your lifetime value and your acquisition cost, and you can get your money back fast. So let me just take a case. Let's just imagine that we are all gathered together because we were just suckers for lighthouses, right? So, and I was the only guy in the world who created this magazine called Lighthouse Digest, and I could sell this magazine to each and every one of you because you just love it. So seemingly, I could convince myself that given that you all pay up front for 1 year, that's really nice on my cash part of it. But on the other hand, I could probably also get you to buy that for several years because you really obviously love lighthouses. So I could tell myself that this is really good business. You get your money back several times, you get it back fast. The trouble about, I really don't know how big the market for lighthouses interest is, but I would assume that it's not that great. So that leaves the third thing that you need to convince your investor about, the growth opportunity. Because you need to be good at your profitability, you need to portray that you can get your money back fast, but you also need to portray that the market is huge, that there's more than there's a bunch of you who likes lighthouses, that there's a lot of channels in which you can keep aggregating new customers all the time. So if you can convince customers or VCs that you have profitability, fast cash, and you have huge potential for growth, and you know what lead sources that you get them from, that's where you want to be when you're investing. So if you are to remember anything from these slides today, it's definitely try to aim at 3 times your lifetime value over your acquisition cost, and in best cases, you would like to have your money back within 12 months. That's really decent metrics. And that doesn't matter whether you're a B2B or B2C company. So metrics in context. The thing is, can I go back somehow? Yeah. This is a very busy slide because I created it as a PowerPoint slide and then all the animation is left out. But what I'm trying to say here is there's this beaten track for becoming a really huge startup. If you start out in Denmark and you get your pre-seed investment, this is the maturity, by the way. This is we have Denmark here, and then we have Northern Europe, and we have Europe and US. So if you want to be a really big company, usually it's very hard for you to come with your case and go to a US investor, because they don't want to invest on anything that is not home turf, unless it's really big. So the US investor is the one not listening to you right there. So that's not going to happen. And the more mature you get, the more likely you can get a bigger and bigger investor, and that's going to be the US probably investor down here when you get to your B level, B funding round series. So what I'm trying to say here is that there's this beaten track of becoming big. You raise money in Denmark, and then you do some in the Nordics, and you might in Europe, and then you end up in the US. So, but initially, you just need to know your basics. You need to have an idea on how your customer lifetime value is, what your acquisition cost. But of course, you don't need to see it play out. For instance, in Templafy, it has existed since 2014. We really, we have around 200 customers now. We really don't see any churn at all. I think, actually I know, our churn percentage is about yearly 2.5%. So meaning that the customer will stay on for around 35 years. That's what, obviously that's not gonna happen, but we cannot sit around for 35 years to see if that's actually gonna happen. So we have guesstimations, we have qualified guesses on how that's gonna work. But the more mature we become, the more you really need to understand every single metric. You need to understand, for instance, instead of just your customer lifetime value over your acquisition cost and how fast you get it back, you need to understand for each of the sales channels you have. We have 4 different sales channels. We have 4 different lead channels. For each of those intersections of sales channels and lead channels, there could be agents getting inbound leads, or it could be our implementation partner getting outbound leads. For each of those intersections, I would need to have an idea on how well is that functioning. How many times I'm getting my money back for each of those intersections. And that requires that you spend a lot of time fiddling around and understanding everything. And of course, you need to know a lot. And I'll get into the very last slides that I have is around specifically that. So just to initially give you an idea on how dumb PreSeed are. I mean, that's not the case because that's me who were dumb and invested into a silly case. But it's how naive and gut-believing PreSeed is sometimes. And what you need to be, how really good you need to be at this point. So this is an example of a crazy investment case that only a VC should do. And I was the one, together with some of my colleagues, who were actually the one dumb enough to do this silly case. It's Mofibo. We invested before they had one single customer, and they couldn't show jack on profitability. They had an idea that customers only read a certain amount of books, and they were paying for each book, and they were selling a buffet style, all you can read for 99 kroner. They were paying 60 kroner per book, 60 to 80 kroner, which is a really silly idea. We didn't know anything about cash, and we really didn't know about how big the market is. So that's, but we managed to do the investment anyway because we had a lot of trust into the investor. That was Morten Strunge. He's sometimes in the papers because he's doing a new startup. So we had the idea that the entrepreneur was really knowing of what he was doing and knowing how to get to becoming profitable. And we also had an idea, given that the amount of books that was read electronically in US was around 10 to 15%, and it was only 2% in Denmark. There might be a open window. That's at least what we thought. And the product didn't exist. We invested into something that wasn't fully. So that's just to give you an idea. You don't need to be all over your metrics and understand everything to begin with. It comes along the way, the further you grow. Morten, he actually managed to get a round of, I think, 5 million initially, not having any of this. But of course, he had good track record on other things. And he managed to sell it for a decent profit. Examples from Templafy. The thing is, Templafy, we also went the beaten track. We got PreSeed, Seed Capital, Sunstone, And then we recently did a funding round on $17 million from American US. And the thing is, the reason why it was this big round was that the US couldn't be bothered investing into something with less than $15 million at a time. The thing is, they are fiddling around with $18 billion, and so the check sizes need to be of some size before they want to fly over and do it. So that's because 17 million round for our company was actually kind of a lot, but we managed to spend it all. So how did we actually convince the investors? The thing is, if I would show you our annual statements, it would look something like this. In 2015, we spent 50 million and we got 1 in revenue. In 2016, we spent 26.5 in revenue. And I mean, if you were a bank guy, you would think this is horrible. Yeah, so obviously that's not the slides that we produced. The way that we convinced somebody that it's actually a really, really decent business that we're doing is making classic VC deck with the pain and the market, the product, blah, 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 and only 3 slides with numbers. That's sufficiently enough to get your the attention of the investors. And the one slide that keeps coming back is the metrics again that I showed you before, is the ratio between customer lifetime value over your acquisition cost. And again, they are really interested in knowing how fast can you get your money back. And in our point of our issue regarding getting money back fast, we knew that investors, they would love to see that we get back within 12 months. Our issue is that we got our money back in 24 months. So we were trying to portray it differently, saying on average the customers paid 17 months up front. So actually we only need to throw the 1.5 invoice to get our acquisition cost back. So that's trying to hide that our cash part of the equation wasn't that good as we hoped it should be. But so this is the metrics that got the investors keen. To give you an idea on the level of metrics that we are producing right now, I'll just briefly run into this metric deck that I send out once a month. Overall, we have some finance and VC metrics. We look into our pipeline, we look into our customer base, we look into sales efficiency. I mean, our ability to convert opportunities into sales. How is that? Are we converting 20%, 30%, none percent? Customer success, how happy are the customers for our product? And retention, our ability to retain our customers and do upsell. So this is what we send out every month, and giving an idea on how the business is doing. And I thought, I know from having seen a lot of companies that this is very comprehensive. Not many companies have that level in metrics, but the funny part is that when our new investor, Inside Venture Partners, came along, they took us to a complete new level. There's actually one slide before I go to that. One thing is also important, besides the lifetime value over acquisition cost, besides the cash, besides the growth, your ability to project and actually be on target is also imperative for investors. So our ability to actually reach our target, this is the green line, and I took this with us because we're doing really good. We weren't projecting cash that well because we're a bit too optimistic on when the customer is actually paying, but we are pretty stringent on the cash or the cost situation. So this is just another thing that, besides the other things, investors like to know that you're trustworthy when you are looking into budgets. So, to give you an idea on of what Inside Ventures they ask us to do, they ask every single of their companies to do reports. So this is their quarterly report. And just to get back to my point of what is really interesting for in terms of metrics, it's our current Q4 attainment. That's relating to the other slide. Our ability to actually do as what we had said we would do. Then our growth, and also our ability to retain, and then our acquisition, our payback. So these are the most key interesting metrics that they look into in all of these numbers here. And again, that's just to highlight that basically there's these elements that you really, really need to know: profitability, cash, and growth. And there's a lot of ways of portraying it. Different, this is how many new sales did you do, how many upsells, how many downsells, blah, blah, blah. So that was the quarterly sales report, but we also do a quarterly benchmark report. This allows us to be benchmarked with 148 other investment inside venture capital companies. So we really get a very good idea on how are we doing compared to others that are like to our size. And again, just to underpin what I said, growth, productivity, customer acquisition cost, and your ability to retain customers. That is the imperative thing that they always look into. And for us, it's really nice to get an idea on how are we doing on a lot of metrics compared to other peers. For instance, this is just to give you an idea on if you're a company that is doing less than $25 million in the AR, annual recurring revenue, you should expect that you are doing 77% of new sales versus 23% to selling products to other customers. The more you mature, the greater the ratio or more upsell. And it's just really nice for us. In our case, we have, I think, around 10%, meaning that we haven't really started on upselling, and which is true. We have been spending a lot of time on getting new customers in, and so for us, this is awesome metrics. So we can relate how is our instead of just looking everything on average and just one level, high level. Lifetime value over acquisition cost, it gives an idea of where to set in. This is also another interesting graph that I wouldn't do myself unless somebody asked me to do it, but it makes a lot of sense. It's also how many more times pipeline do you need to have than your expected targets versus your sales cycles. So if you're a company that only have a sales cycle in 1-2 months, you don't need to have a huge pipeline because it's going to sell really fast. So, but if you have a sales cycle that is really long and ours is 6 months, we need to have a pipeline that is at least 3 times our projected sales. So this is just giving us really, really good indications on where to set in and how much pipeline do we need to do and everything. So yeah, that was to give you an idea of what to focus on. And don't be too afraid of, because probably not many of you are having an annoying VC. Those guys are just as annoying that I was to you, just so you know.
That's good.
But there's everything in between, right? Any questions?
It was really interesting. One question could be how do you actually use this internally? I mean, when your teams are meeting, how does it guide your decisions, and how much power does it actually have when you want to launch a new product or you want to look into a new segment and so on? How does it work internally?
It works very well internally because we look into a lot of metrics all the time, and of course it's my job to make sure that we look at the right one with the right cadence. So for instance, I make sure that we look into our pipeline. Is that growing sufficiently enough? And if it's not, I'm starting to get worried. Should we hire some more BDRs calling out? What channels are working the best? And sometimes if I think we're overspending, I tell marketing, I think really we should lower the cost because our marginal effect is not as what I hoped it would be. So all the time, and every time I throw in a lot of numbers for these US guys, and they bring the deck back. I run it through with the management to get an idea. We are not good enough on upsell. We obviously don't have enough pipeline or whatever that could be. So internally, it helps us to trying to figure out what part of our sales engine should we spend more time on. But it doesn't come automatically. It really comes by looking and relating to all the numbers.
So given your product is a PreSeed product, how do you factor
What kind of product?
PreSeed? So you have one customer that might buy 10 licenses and some buy hundreds, right?
Yeah. Usually we go for trying to sell enterprise-wide and at least 1,000 seat at a time.
Well, doesn't.
Okay.
But still, how do you factor that into your reports? The rise and the fall of a customer. Some customers might buy 1,000 and fall to 500 and 1,000 again. How do you factor that into your reports?
We really don't have that trouble very much. But if a customer goes from let's say 1,000 to 2,000, we consider that as an upsell, and if it goes down to a less, we consider that as a downsell. And we look in for instance this one. We look at upsell and downsell. So we look at but so and then there's churn on top of that. So that gives an idea on how our ability to actually retain the MMR, the monthly recurring revenue that we had. How are we doing more upsell than downsell, and how does it actually look over time? Yeah.
To get to that point, can you talk a little bit about how you have automated this, or is it still very manual for you? What did it take you to get to be able to produce this?
I would say it's imperative that you get the right systems as fast as possible. So when I was on the board of Templafy, I really recommended getting a really decent CRM system. So you can track everything also historically, because it's just so imperative that we have a very good idea on, for instance, conversion rate. So if I can get 20 new opportunities, I really have a great idea on what the conversion rate is that's going to be. So I can project saying it's going to take that long and they're going to throw that much money in. So and it's going to take time, and it's going to take a lot of fiddling around with reports. And the best thing is it's actually if you have. I can call my investors up and ask if I can share this. But if you have an idea where you want to go and what you need to portray, and then you reverse engineer thinking, okay, then I need to set up my Salesforce or my HubSpot CRM system to do that. But you definitely need your accounting system and your CRM system working properly. And that's the most important. Then you can have the customer success system, you can building system and all that. But the core is having a really, really good CRM system. And I really don't recommend buying a cheap one, because if you're actually becoming a good company, you would need to have all the features that is relevant. So you need to buy the expensive solution anyway. So you might as well do that initially, because you're gonna bump into a massive pain of converting from a crappy CRM system to a good one. So invest into great software. That's the investment that I always recommend to do.
So, should we take one more last question and then take the break after that? I think that's good. So, in terms of keeping a focus on retention and churn, how much have you guys worked with the first golden action in terms of define as the customer, what's the first golden action the customer does in order to get started with the product and actually feel the value of the product. What do we need them to do? Maybe in HubSpot's example, it was getting them to view that, do that 4-hour class in order to really understand the value and get started. How do you work with like the first?
Well, the thing is, we roll this out for huge corporations, and some of them, they take a lot of time before the product owner actually decides to roll it out, because they wait for the perfect moment and whatnot. The way that we prioritize, we have a customer health score, right? It's a mixture between how many products do you use and how many are activated and how often do you use it, everything. And this is customer health score this way, and this is our renewal. So we are actually very the other way around on your question. We are trying to cater for the ones that we know are going to renew within the half year. And that's where we definitely set in. And that's our key area of customer success right now, is trying to see, okay, are those guys happy enough? But if you want to flip it around and making sure that they get on the right foot initially, we are increasingly doing that, but it hasn't been a concern at all, because most of our customers are actually, they sign up for 3 years, and we have a pretty decent customer health score to begin with. So it's not really a concern, but of course, all this is 100% of customer health score. We could move it up a tad more, but it hasn't really been. It's been more putting out potential fires than it has been getting on the right foot, but we are transitioning to do that. And for that reason, I recently bought another expensive software tool to help me with exactly that.